Hi, I'm Corey Bannister from Trobe Financial, and today I'm going to talk to you about some of the myths associated with non-bank lenders. As you know, the Australian financial landscape is changing considerably in recent times. We're seeing the simplification of the major banks' strategies, which has resulted in a constriction of credit and cautiousness amongst consumers. Consumers yesterday could go to the major bank with confidence that their needs would be served. Today, this is not always the case. That's where non-banks come in. We're stepping in to fill the void left by the major banks to ensure many Australian consumers who were previously bankable clients can still have their finance needs met. Number one, that non-banks only deal with people with impaired credit history. What we're seeing now is an increasingly high standard of credit applications coming through. We've seen the major banks, as part of their simplification strategy, either exit out of particular product segments or perhaps tighten their criteria to a point where yesterday's bankable customers are now coming to non-banks for a home. We're seeing more prime applications than ever before. Sure, we do cater for borrowers with credit impairments, but it represents only a really small part of our business now. What we are seeing is some more applications for those with income variability, employment variability, the rise of the gig and e-commerce economies, Uber, Airtasker, second, third jobs. We're seeing more and more of this, and major banks' automated credit scoring systems just simply can't handle it. It needs a manual credit underwriting process, and that's what non-banks afford. We've got the human capital here available to manually assess and give each of those applications the due consideration that the major banks at this stage are not in a position to do so. So it's not about credit impairment, it's often about people who have some kind of variability in their employment, their income situation, and they need a manual credit assessment. Myth number two, that non-banks are expensive. We have rates starting from 3.99, which is very competitive in today's landscape. That said, there are some non-banks who have even cheaper rates for really prime customers, and their sole value proposition is to compete with major banks on price. We'd encourage any borrower to go and check non-bank lenders online and compare their rates to the major banks. Myth number three, that non-bank lenders are not financially secure. This one I can debunk for you right away. We've seen in recent times significant investment from some of the world's largest alternate asset managers from overseas investing into the non-bank sector, directly into the share registers of some of the largest non-bank players in the market. They're doing this because they've got great conviction over this space. They see the opportunity non-banks supply to the marketplace. They see the challenges that the major banks have and will have in the coming years, so they've invested heavily to support both the non-bank sector, who supports Australian consumers. Myth number four, that non-banks have less product options. This is a myth I'd like to bust for you right now. We have one of the broadest product suites in the market and cater for every customer life cycle, right from first home buyers through to upgraders, downsizers, wealth creators, business builders, and even aged care facilities. So we don't just have a homogenous product which is a one-size-fits-all from first home buyers all the way through. We actually specifically split our products into niche areas so that we are actively catering for those particular market segments. We have a parent-to-child loan which caters for first home buyers. So it recognises the support that mums and dads provide many Australians in terms of their deposit to get on the property ladder. It's a cost-effective way to get the children into the property market sooner, and also provides protection to the parents. We have then moved to loans that cater for the self-employed market. As you know, self-employed borrowers are the engine room of Australia's economy, and we have our Light Doc loan, which we pioneered back in 1990, which really targets self-employed borrowers who perhaps don't have their financial statements in order and therefore do not pass the major banks' automated credit scoring models. We're happy to manually assess this segment of the economy. We have great track records of helping self-employed borrowers throughout their whole credit life cycle. We then have products which are targeted to building wealth. We have self-managed super fund products which help people purchase property in readiness for retirement. We know Australians love property, so we have loan products there that allow them to invest in the asset class that they know, trust and like. And then we move on to our aged care loan. So that product is aimed at mature age applicants who unfortunately are at a point where they need to move into an aged care facility, but they're not quite ready to move out of their family home. So we have loan facilities set up that allow them to access the equity and then move them into an aged care home. So as you can see, we really do have a product for every life cycle. Myth number 5, that non-banks are not regulated. This is probably one of the biggest myths about non-banks that we find unhelpful and like to set the record straight now. First of all, we are regulated. We hold an Australian credit licence. It's the same Australian credit licence that each of the 4 major banks here in Australia hold. In fact, it's the same credit licence that any credit provider in Australia holds. It's issued by ASIC and means that we're regulated by RG 209, Regulatory Guide 209, and need to abide by the responsible lending guidelines. The second part is, the comments are often that we're not APRA regulated. APRA do have reserve powers over the non-banks and have said that they will step in when they see systemic risk occurring from the non-bank sector. Now, APRA does get a look into the non-bank sector through the bank warehouses that many non-banks operate. So non-banks will source part of their funds, typically, from one of the APRA regulated major banks, and therefore the reporting requirements that go back to those banks are passed through to APRA. So APRA do get a look in, and you'd be crazy to think that APRA wouldn't step in if they saw something untoward going on. The third piece is through our bond markets. So we run an RMBS program where we have a number of domestic and international investors investing in our loans. We're independently rated as part of that process, and we have regular audits going on these programs as well. So there is certainly plenty of scrutiny and oversight into these businesses. The fourth bit that I'd like to talk about is that some of the larger non-banks have received significant investment from overseas investors. A number of our share registers have now got alternate asset managers from some of the world's largest organisations. There's a huge due diligence requirement that comes with this, which also validates how appropriate our practices and policies are.